and welcome to a brand new episode of ET Markets Smart Talk, a show where we talk about market trends, investing yarn, as well as techniques and how to become an effective investor as well as trader. Well, my name is Shattajanand, and today we have with us a very special guest, Nilesh Shah, who is a managing director at Kotak Mahindra AMC. Welcome to the show, Nilesh.
Thank you, Ksitish, for having me over here.
I'm sure at this point in time, our viewers would want to know what is happening with the market at this point in time. What is the market trend saying? And do you think that the worst is maybe behind us and the bull market correction is almost done?
Well, market is seeing a very, very interesting tug of war. It's a tug of war between, let's say, domestic investors who are buying and foreign portfolio investors who are selling. It's a tug of war between optimist and pessimist. For example, in Russia-Ukraine situation, the optimist is believing that there will be some political solution. Russia is too big a state to be kept under sanctions and ignored. The pessimist is saying that no, there will be further escalation, and this could even lead to higher fatalities. On oil price, the pessimist is saying that, look, at some point of time, European Union will stop buying Russian oil. Their supply will also go out of official market, and oil prices will go further higher. The optimist is probably thinking that Iran and Venezuela will, excess oil, their oil also will start coming into the market. And oil prices will stabilize or come down. The pessimist is saying that look at US employment data and housing market. The Fed rate will go higher than what is priced by the market today. The pessimist is saying that look at the recession. First quarter GDP in US came negative 1.4%. And in that scenario, Fed may not raise rates as much as they are expected to raise. So essentially today there is a fight between buyer and seller, optimist and pessimist, who have different outlook on how things will happen. And it is their tussle which is keeping markets somewhere between 16,000 to 18,000 Nifty. Who will win? I don't think so. Today we have ability to say that. How events happen in future related to Russia-Ukraine situation, related to oil, related to US Fed rate, and correspondingly in India from inflation interest rate trade-off will determine which way markets will go.
Right. In fact, you've given an extensive research on the optimistic and the pessimistic scenarios, and I'm sure our viewers will take note of that. Now, coming to the next question. So what do you recommend investors to do with their portfolio allocation at this point in time?
So, Ksitij, our advice to investors have remained same irrespective of market situation.
Right.
Please be a regular investor. Please be a long-term investor. And most importantly, please follow Dharma of asset allocation. From an equity point of view, this is not the market where one will be leveraged as there's so much of uncertainty. This is also not the market like March, April, May 2020 that you could be overweight from a valuation point of view. In those days, India's market cap to GDP ratio was about 50 to 60%. And hence, overweight despite COVID was necessary. This is the market where valuations are fair. We are in line with our historical average valuation. So maintain neutral or equal weight asset allocation. Keep dry powder for correction. If the events don't turn out as expected by the optimist, there will be correction in market. Please average at that point of time. Don't buy at one go because there will be lots of volatility. But stay invested. because events predicted by optimists can also happen and pull market up. Keep dry powder also, because events expected by pessimists can also happen and pull market down.
Golden words from you, Nilesh. Follow the dharma of asset allocation. I think this is if somebody stays with it, I'm sure they will be able to create wealth over a longer period of time. Now, I think the next question is around about earnings, and why it has become important is because uh, you could say in the last 3 or 4 quarters, everything was, every voice on the last street was about that it's going to be an earnings led recovery on D Street. And after US and Russia crisis, there are, the voices have grown that there could be earnings downgrade. And especially at the time when both US Fed as well as RBI might be increasing rates in the near future. So how should one look at the earnings in the next upcoming quarters?
So if we look at the March 22 quarterly results, by and large, despite some impact of higher oil prices and inflation, earnings came in line with estimate. 36 out of 46 Nifty companies which have declared results so far, their results were either ahead of estimates or in line with estimates. The disappointment was just on 10 odd companies, which is fine. But the real challenge is not the past. The real challenge is the future. With so much uncertainty, companies are not confident talking about the future. Now, there are some exceptions like IT where demand is strong, but many other industries are not able to pass the price rise to the consumers. We believe for June 22 quarter, top line will be still higher because of the inflationary impact, but margins will get squeezed because companies are unable to pass the price rise. However, as I mentioned, as events happen on oil, on interest rates, on Russia, Ukraine, earnings will get impacted positively or negatively. We still maintain earning of anywhere between 825 rupees to 875 rupees for Nifty 50 companies in FY23. Now, the range is fairly wide. In December 21, we were expecting about 875 earning per share for Nifty 50. Now, because of uncertainty, we have reduced it to from 825 to 875. The quality of earning also is changing. Earlier, earnings were, dominated by IT, pharma, banking, and financial services. Now it is dominated by commodity and cyclical companies like metal companies. So you'll have to not only look at quality of earnings, but also quantum of earnings. And with this uncertainty, it is a bit difficult to say which way we will go. But anywhere 825 to 875 earning per share for Nifty 50 companies in FY23 looks likely.
Right. Now, the next bit of advice we are looking at from the new age investors. I'm sure we've seen a lot of new age investors coming to the last street post 2020, or you could say March 2020. So a lot of new investors came into the limelight, and this is probably the first time when they're actually seeing a drawdown. So Nifty and Sensex is probably down more than 10% at this point in time from their respective highs, which was back in October 2021. So do you think that, this could be, and we are seeing dip in SIP flows as well. So do you think that the new age investors which have come back in or the retail investors which come back with a fury on D Street might just start receding, or the additions to the equity markets might start receding? What is your view on that?
So Kshitij bhai, I still vividly remember Anil Kumble wearing a plaster and bowling to Brian Lara, if I'm not mistaken.
Okay.
Just previous day, he was hit hard by a fast bowler, and yet he came to bowl with that fracture in the jaw with plaster. And if I'm remembering correctly, he ended up taking wicket of Brian Lara. Something similar also happened with Sachin Tendulkar when he was young and had gone to Pakistan, and one of the fast bowler, most probably Waqar Yunus, hit him hard and he was dropping blood. But that didn't stop Sachin Tendulkar or Anil Kumble from, letting it go. They took the blow, moved forward. In recent times, Cheteshwar Pujara showed that against that on that Waka pitch, where Australian bowlers were bowling fearsomely, and he was taking the blow on his body, but he continued batting and helped us won the match along with, I think, Rishabh Pant. Why am I taking names like Tendulkar, Kumble, or Cheteshwar Pujara? Even with their skill set, they could not avoid injuries. They could not avoid body blows.
Absolutely.
So, request to the investor, recommendation to the investor is that in the market, you have to take losses. You have to suffer the pain of seeing drop in the value.
Sure.
In March 20, all of us saw our portfolios coming down by more than half. But we didn't, left the match. We continued playing. That's why today we are scoring runs. So my recommendation will be that don't worry about this losses, this drop in values. As uncertainties recede, the losses will be converted to profit. My feeling is that with ET Now and many other media channel communicating this message to investors, that ups and downs, volatility, rise and fall is part and parcel of the market, most investors will take this by stride and not move away from market. In fact, over last 24 months, we have seen that domestic investors are supporting the market.
Absolutely. Yes.
I hope and pray this maturity continues.
But yes, our retail investors have a lot to learn from our cricketers. And yes, golden words from you, Nilesh Shah, on that front. Now, let me also quickly ask you something about on valuation perspective. Now, Nifty P has sort of dipped below 20 times. Now, do you think that we are at comfortable levels in terms of valuation from a long-term perspective, or we're still expensive compared to other EMs as well?
So we are undoubtedly hugely expensive to other emerging markets.
Okay.
We have done so well over other emerging markets that it is a big revelation. From 2014 to 2022, we have delivered double the return of emerging markets. We have delivered double the return of China.
Okay.
And I don't know whether it's true today or not, but when I calculated from 2014 to 2022, our returns was more than multiple other peer countries like China and Russia and South Africa and so on and so forth.
Okay.
So we trade at a significant premium to our own peer group. We are probably twice more expensive than China, twice more expensive than Brazil, twice more expensive than South Africa, and probably infinitely expensive to Russia as their markets have corrected.
Yes.
But from our own historical average point of view, we are now trading at about 18.5 times FY23, which is in line with our historical averages.
Sure.
Now, the real question is, will foreigner look at India's valuation, or will they look at our performance? If they look at our performance, they will realize that we have delivered double the return of our peer group over a long period of time. And hence, they may join hands with local investors to buy India. If they look at our valuation, then they may continue to sell, and we'll have to wait for our earnings to catch up and also other countries' valuation to rise. But I believe India will continue to trade at a premium. In terms of ESG ranking, our governance standards, our environmental and social consciousness is significantly better than our peer group. So we will trade at a premium, but will we be able to sustain today's premium over emerging market? Looks a bit doubtful.
So when will the selling abate from FIs, any?
Either others have to come up so that the gap narrows
The
and
gap
people
narrows.
turn around, or people get convinced that, in India, let's ignore valuation and invest for a longer period of time. I may not make money in a year, 1 or 2, but India is lambi race ka ghoda. So near-term uncertainties are undoubtedly pushing people to take profit out of India.
Right.
We are way ahead of our peer groups in terms of valuation. We are probably one of the few emerging markets where FPIs can sell $1 billion and get an exit. There is no exit in Russia. In China, if you exit, they will not allow you to enter. In Brazil, they are entering or they are investing because it is commodity producing country. So because of our valuation and because of our liquidity or exit which we provide, my feeling is that some of these FPI flows are likely to continue.
Right. So in all the midst of this, so how you're picking your winners? Which sectors are you are on your value list, and which are you're planning to go underweight on?
So one, we are very, very conscious of companies who are in real businesses.
Okay.
We don't want to make the mistake of investing in businesses which are not real. Fortunately, with SEBI's regulatory supervision, this subset has become extremely small. And it's more in areas of micro caps and mini caps and small caps rather than mid and large cap.
Right.
Second focus is on valuation. I don't want to invest into very, very expensive stocks where, because of low floating stock or because of concentrated holding, prices are way ahead of their fundamentals. At the same time, we also don't want to go into very cheap stocks because they might be cheap for a reason. So primarily, we are investing in average valuation around historical valuations. With this two caveat of governance and valuation, we are bullish on sectors like banking and financial services. Interest rates are rising, so margins will be positive. They are having very good provisioning for the NPS, and outlook on NPS seems to have bottomed out. Put together, this and valuations have become reasonable. The second sector where we are bullish is large cap IT. IT stocks are today correcting all over the world, but the demand continues to remain robust for large cap ITs. We believe they will be able to provide growth ahead of market expectations. The third sector where we are bullish is industrials and engineering. This is slightly longer term call. Order books are picking up. Exports market are opening up. And because of the lean period of last couple of years, costs have been cut dramatically. Operating leverage will kick in as order book starts getting converted into sales. So across banks, financial services, industrials and capital goods, IT sector, we are looking at companies which are better governed, have real business, and are available at reasonable valuations.
Right. Absolutely. And in fact, a very rigid and a strong, notes that you've given to our viewers as to how to also pick sectors at this point in time. Well, on that note, thank you, Nilesh, for your time today. And well, that's all for now, but do stay logged on to etmarkets.com for more on news, business, and economy. Again, thank you so much for your time and your golden words.